Hi, I'm Gaalen from Equity.Guru, and this is my 3-minute hit on the importance and use of balance sheets when it comes to investment. So, what's a balance sheet? It's an important financial document that's put out regularly by a public company, which basically gives you a snapshot of the company's financial position at any one time. There are two major sections on a balance sheet, and that would be assets and liabilities. Both of those sections are broken into two categories. In current assets, you would have your money in the bank, or let's say accounts receivable. Anything that you can convert to cash or use as cash in the next 12 months. Long-term assets would be like intellectual property or real estate or equipment, things that a company owns and considers assets but can't be converted to cash over the next 12 months. Liabilities, in terms of current ones, would be, let's say, accounts payable or short-term debts. Something or items that the company has to pay out or deal with over the next 12 months. Long-term liabilities like long-term loans or leases, these are things that the company still has to pay but doesn't necessarily have to deal with or pay out over the next 12 months. The remainder you have is called shareholders' equity. This is the capital left over after subtracting liabilities from assets. Now you take all three of those items, basically subtracting liabilities and shareholders' equity from assets, and you end up with a zero. That means that the account is balanced. This is why it's called a balance sheet. So why is this important, and how can you use it as an investor to determine the potential of a company for investment? Well, basically, you can look at things, let's say, as the cash balance, for instance. This is the cash the company has on hand, that it can deal with things that if stuff goes sideways over the next 12 months, they have money to cover, let's say, salary or leases or whatever else that may come up that they can deal with. A stronger cash balance means a stronger company. Also, you can determine something called debt to equity ratio. This shows you whether the company is bringing the money through the door through, let's say, equity investment, meaning people buying shares and stuff like private placements and things, or whether they're raising it through debt. Now, the stronger debt to equity ratio, meaning the more debt to equity that the company has, doesn't necessarily bode well, and you may want to take a second look at something else before you actually put your investment in a company such as that. You can also determine something called return on assets. This return on assets is an equation that you use by taking the net income the company reports in their financial statements and dividing that by the amount of assets that they have. The more income they have to the assets means a stronger performing company. So that's my 3-minute hit on a balance sheet. Pretty basic, but it gives you a good idea of what it means and how to use it. If you want more information or more how-tos on how to deal with the world investment, you can hang out here on our YouTube channel or go to our website at Equity.Guru. We'd love to hear from you. Take care.